name is Bernardo Pereira. I'm a tax partner at Forvis Mazars in Portugal, and I'm leading the private client and global mobility team in Portugal. Forvis Mazars is an international firm with presence over 100 countries. We are specialized in audit, accounting, outsourcing services, financial advisory, consulting, sustainability, and indeed as well in tax advisory services. And all around, from corporate to individual taxes and to VAT, transfer pricing. So we are a full range consultancy and audit company. In Portugal, we are more than 300 people. Around the world, we are over 40,000 people. I'm a tax partner at Forvis Mazars in Portugal, and I'm leading the team working on private client services. In Portugal, the tax residency rules are quite clear in the sense that we have a very well-known rule concerning the 183 days of presence in Portugal. And we also have another rule that states that you are resident whenever you have an habitual resident at your disposal in Portugal. One of the main challenges here is indeed in terms of the cross-border situations, not only about the rules in Portugal of becoming resident, but also assuring that you are non-resident in the country that you are living. And it's a very important consideration to bear in mind to avoid situations where you could become resident in two countries and therefore triggering double taxation situations. In Portugal, this new regime, the NHR 2.0, indeed delivers a lot of tax advantages compared for the normal tax regime in Portugal. So whenever we are comparing the 20% flat tax rate to the progressive rates, there is indeed a huge advantage for someone that is able to be within this regime and be eligible for this new framework. Besides that, we also have as an exemption on foreign source income for everyone that fits within the regime, and that also is something that can make a huge difference in the tax bill at the end of the year. The first tax challenge that any expat will face in Portugal is indeed to be sure that all compliance obligations are fully met and all contacts with the Portuguese tax authorities run smoothly, from the first interaction to become tax resident in Portugal to every year submitting the personal income tax return. On another level, there is indeed the necessity to be sure about how this new regime fits the sources of income of a certain individual, either because a full exemption on foreign income does not include pensions, for instance, as some sources of income are not directly included into this regime in terms of what is the nature and how to fit that income into this regime. So it's very important to have a smooth compliance process established and to be sure how this regime fits the sources of income of a certain individual. Whenever you are non-resident, you are only taxable on your sources of income that are derived from Portugal. Whenever you are resident, then we have two ways of analyzing the situation. Either you are under the general regime or you have special taxes regime. On the general regime, normally it works within a progressive rate system where the more you earn, the higher your rates are, and that applies mostly to employment income, pension income, and then within the resident regime, you are also able to apply some flat rates, particularly on capital gains or dividends or interests. Then, still as resident, we have special tax regimes, and that is something that will allow you to have a flat tax rate on your salary income instead of the progressive rates. The progressive rates can go up to 48%. In general, we are dealing with a situation where the flat income tax rate can be of 20% within the special tax regime. This special tax regime also provides you with a full exemption on foreign source income. It's very important to understand that we are dealing about foreign source, so on Portuguese source income, even within the special regime, the general rules for Portuguese residents will apply in that situation. The NHR 2.0, this new regime that for simplicity purposes we call it NHR 2.0 because it's indeed an evolution of the NHR that previously existed. It happens that there are two main changes here in two different perspectives. One in terms of how to become eligible to this regime, another one in terms of the tax rules that apply whenever you are within that regime. On this first criteria about how to become eligible, there is a huge change about what happened until the recent past. So for now, it's mandatory that you have not been tax resident in Portugal for the last 5 years. That's not different from what happened until or within the NHR, but you are now required to have some sort of employment connection to a Portuguese company that was not required in the past. So this new regime is really targeting the attraction of high qualified individuals to Portuguese companies. There are specific criteria that those companies need to meet so that the person is eligible. So it's not longer something that the person can entirely control, but it's also something that anyone needs to assess with its future employer in Portugal, to assess if the company meets the requirements that make that person eligible for the regime. From a tax rule perspective and what changed, first it changed that because of the reasoning behind this regime of the attraction of high-skilled individuals to Portugal, pension income are not longer subject to any kind of special regime. So pension income is subject to progressive rates in Portugal. The flat tax rate on salary deriving from highly qualified activities is still 20%. And there is now a full exemption on foreign source income, which is slightly different from what happened in the past, particularly related to capital gains, which are now also within the scope of the exemption defined by the Portuguese tax law. The eligibility for the NHR 2.0 depends from the employment relationship, but there is no limitation that you own the company. The fact that you own the company in itself is not sufficient for becoming eligible, but there is indeed no limitation that you are employed by a company that you own, but that the employment relationship still requires it to meet all the criteria set by the Portuguese legislation for that activity to become eligible for this new regime. The NHR 2.0 provides a full exemption on foreign source income. This means indeed that Portugal, whenever you have a foreign source income, will not subject that income to taxation. It doesn't mean that another country may not do that. A very good example of that is whenever you are dealing with real estate capital gains, it's very likely that according to the double tax treaty, the country where the property is located may also tax that capital gain. So you need to be prepared that the exemption in Portugal doesn't mean that you won't be taxed anywhere else. It simply means that you are not taxable in Portugal, but you need to assess according to the nature of the transaction if any other country may tax that capital gain. From a Portuguese perspective and our relationships with the US, and whenever we are dealing with a US national, it's important to bear in mind that the taxation rules in the US are not based on the residency, but based on the nationality. This means indeed that you may be resident in Portugal for tax purposes, but at the end you have still some liability in the US. What happens then is that although you have maybe a tax liability in Portugal, that can be or either deducted in the US or that you can deduct your US taxes to your Portuguese tax due. This means that there are mechanisms already established to avoid double tax situations because of this mismatch in terms of how you define your tax status in the US based on nationality and in Portugal based on specific rules for you to become resident in Portugal. This new regime, as the previous one, the NHR and the NHR 2.0, also have exceptions to what we in Portugal define as tax havens. This tax haven list is published by the Portuguese Finance Ministry each year or whenever it needs to be updated, and it means that those jurisdictions have an aggravated tax framework, and it's very important to assess if those sources of income have any origin in those locations. This is particularly challenging because the tax haven list is made from a Portuguese perspective, and it means that, for instance, from the US jurisdictions that people are used to work with may not have the same framework from a Portuguese perspective. So that's why it's very important to assess beforehand what are the sources of income, where are they located, and how do they fit or not this tax haven list to assure that something that could be working as an exemption is at the end subject to taxation because of the source of that income.